Oh, you got a basketball thing to get to.
I do, but I'm gonna watch at least 20 minutes of this and then I'll go over there. It's just a virtual online thing, so.
All right, so today we're going to do what we would have done had we been in class. We would have all been in the library, and I would have gone through stock valuation with you. I had to do this market watch stuff to hopefully learn a little bit especially how investing is not gambling, and that's kind of how we're going to wrap up the week, is talking about that. And one of the ways investing is not gambling is because there are ways to quantify evidence of a stock's performance in order to make a more educated guess about what it will do in the future and determine whether it's a good investment, which is obviously something you can't do sitting at the roulette table or the blackjack table. So stock valuation is a way of quantifying this, and the goal of stock valuation is to determine the intrinsic value of a company. In other words, the company's fundamental economic value. And if the market price of the company's stock is greater than the company's intrinsic value, you should sell the stock. If the market price of the company's stock is less than the company's intrinsic value, you should buy the stock. If there's the possibility of it, if it's less now, but it will grow into more, and you already own the stock, then you should hold the stock. And those are the three recommendations that you would provide any stock were you an investment professional, or if you're considering your own portfolio: buy, sell, or hold. Now, determining a company's intrinsic value is one of the most challenging responsibilities that an investor has. Determining the value is accomplished using various tools. There's dividend discount models, fundamental analysis, cash flow analysis, and technical analysis. And I'm going to go through some of these, and then we're going to do Market Watch Journal entry number 4, utilizing fundamental analysis, since it's the most common, to kind of get a look-see at, okay, how do you judge whether a stock is a good investment or not? So with dividend discount models, they regard the value of a stock as the present value of all future dividends that will be earned while holding that stock. And these dividends are discounted at the company's required rate of return, or discount rate. In other words, what rate of dividend they actually pay. And the value of a company's common stock is found by dividing the dividend you expect to have in the future by the current required rate of return you require for holding the stock, or discount rate K minus the stock's long-term growth rate G, K minus G. So D1 divided by K minus G, it represents the value of the stock. And the letter G represents how fast you expect the stock to grow over the next 50 years, the long-term growth. And it's very difficult to determine the exact value of a company's stock. This is by no means a 100% certainty when you do these things, but it gives you better guidance than just, wow, I really like these guys, I think they'll do good. So it's very difficult to determine the exact value of a company's stock because you cannot project either the dollar amount of future dividends or the growth rate. However, this model may still be helpful to your stock analysis, particularly if you're looking for income stocks. Cash flow analysis assumes that the value of the company is measured by the discounted value of the free cash flows to all shareholders, including equity shareholders, against stock shareholders. Free cash flows are defined as cash flows in addition to cash flows required for operations and investment. In other words, cash flows of money that is pure profit. That's not money they have to spend to stay open, to pay their employees, to cover their expenses. To value a stock based on cash flow analysis, investors build cash flow models that forecast expected cash flows to all shareholders and to the company as a whole. And while cash flow analysis is helpful in determining intrinsic value, the value of the company often lies in areas that are difficult to quantify in terms of cash flow, such as video libraries for entertainment companies such as Disney. How much is Snow White worth? It's not released in theaters anymore, but the fact that they own it and people use the images from it or lines from it, or they can put it out in the future on DVD or things like that. Or patents for medical companies, the same principle. Technical analysis assumes that supply and demand are the key factors that are necessary to understand stock prices and markets. And since supply and demand are psychological factors in large part, going out and judging technically how people feel about stocks, a certain stock, is very important. So under technical analysis, you might do something like gauge on Facebook the strength of, when you say a certain stock, what are people's opinions about it. If they're, oh, that company sucks and everything, you can kind of guess, this probably isn't going to be a good stock to buy. So technical analysis focuses on the psychological factors that determine a company's value, such as greed and fear, as well as the economic factors that determine a company's value. So while major research studies have found that this type of analysis is not as reliable in predicting stock prices, many of the tools actually used in technical analysis are helpful in managing portfolios, such as price charting, moving average graphs, and other types of price analysis. And fundamental analysis, the last type here, assumes that the value of the stock can be determined by the future earnings of the company. And analysts spend a great deal of time investigating the company and the industry, the global industry, and the global economy to determine the intrinsic value of the company and gather the necessary information for fundamental analysis. Fundamental analysis is found to be a valuable tool for stock valuation, particularly when analysts are able to forecast earnings that are significantly different than the market consensus. In other words, if everybody who's buying the stock thinks, oh, earnings are going to go up, and you've done some fundamental analysis that shows, that may not be the case, well, then you kind of have a leg up on them. And fundamental analysis is the type of analysis that someone like Warren Buffett, the richest man in the world, would use, and he made his money off investing. So we're going to do some fundamental analysis, like I said here. So let's look at MarketWatch number 4. Okay, and this is the 4th of the 5 homework assignments related to your involvement in MarketWatch. And these assignments will have you completing tasks that may seem odd or antithetical at first, but will hopefully lead you to some realization about the market in the future. Each of these assignments has been cursively graded. This is except for the 5th one, which is coming up, which is a short summative paper detailing what you've learned from these assignments. So it'd be in your best interest to do each of them prior to the 5th one, hence why we're doing this one, and Thursday we'll do the 5th one. What I would ask you to do is list 3 stocks that you would like to evaluate. I'm only going to do one just to show as an example. But if you wanted to do this, for the homework grade, then certainly you can. Now, fundamental analysis can be broken down into a few different areas, and that's kind of what I want to do right now. Show you some of these areas. And I need to go back to Google. Okay, so the first area is financial stability. And financial stability has 3 different ratios, mathematical formulas you can use to provide quantitative evidence about the financial stability. And these ratios are useful to check the inherent financial strength of a company and its cash flow pattern. So you have a debt to equity ratio, which is total liabilities divided by total share capital, the interest coverage ratio, which is earnings before interest and tax, and divided by the interest, and the current ratio, which is the most common one, which is current assets divided by current liabilities. So actually, we are going to do the current ratio. And the good news is that a lot of this, and I'm sorry, I didn't even have to do that. A lot of this is, people do this for a living. We'll go out and do these things. So let's say we're going to do a stock. Heaven, go ahead and pick a stock that you would be interested in. Apple. Okay, so all I'm gonna do is I'm gonna Google current ratio of Apple stock. And Apple current ratio, there's a couple different sites here. I'm just trying to judge which one would be the most one. The thing up top tells me about September 2015. I'm looking for something a little more current here. Let's do this one, this Guru Focus. And Apple has a current ratio of 1.6 as of May 9th, which was Friday. So the current ratio is 1.6. And if we go back and look, the current ratio indicates a company's liquidity condition in terms of paying short-term liabilities from its short-term assets. In other words, things that it could make liquid pretty quickly. And warning signs are triggered when this ratio becomes less than 1, and be cautious if this ratio is less than 1.5. Well, their current ratio is 1.6, so it seems pretty good right now. But based on the financial stability, I would recommend buying or holding based on that. But I don't want to use just the financial stability. There's this thing called triangulation, which, if you've taken psychology or sociology, you're kind of familiar with triangulation, using 3 different methods to support the evidence one of the methods is giving you. And so the second way we could do this is through performance indicators. And performance indicators are ratios useful to check the performance of a company. Is it being efficient with its assets? Is it doing business well? Or is it doing it poorly and losing customers and wasting money? So there's 3 different, or 4, actually I think there's 7, 8, 9, 10, 11, 12, 11. There's 11 different ways you can do a performance indicator. There's the operating margin, which is the earnings before depreciation, interest, and taxes divided by net sales times 100. The gross margin, which is earnings before depreciation and taxes divided by the net sales times 100. The net margin, net profit divided by net sales times 100. The return on assets, which is your net profit divided by your total assets times 100. Return on equity, which is net profit minus preferred dividend divided by total share capital multiplied by 100. The return on capital employed, which is net profit divided by total debt plus total share capital times 100. Sales growth, which is this year's sales divided by last year's sales minus 1 times 100. The earnings before interest and taxes, EBIT, this year's EBIT divided by last year's EBIT minus 1 times 100. The PAT growth, this year's PAT divided by last year's PAT minus 1 times 100. The earnings per share growth, this year's EPS divided by last year's EPS minus 1 times 100. The book value growth, this year's book value divided by last year's book value minus 1 times 100. Okay, so PAT I didn't mention is profit after tax. So we have a lot of different ways to look at this here, and it kind of would depend on whether you're looking for this as an income stock or a growth stock on you. But probably I would say the most general way of understanding performance is the operating margin. And so if we go back here, and instead of current ratio of Apple stocks, we're going to look at the operating margin of Apple stocks. And operating income margin currently is 24.5%. Now, what does that mean to us? If we look here, we say the ratio indicates the net profitability of the operation of the business. 24.5%, is that good? Is that bad? Because it's going to depend on the industry. And so what you have is Apple is a technology industry, and we don't know in technology, is 24.5% return good? Other industries, it might be 90% return is what's better. And so what we would have to do with Apple in order to understand whether or not that operating margin was good is we'd have to compare it to other tech companies. So in this case, let's go up here and instead of Apple stock, why don't we change this to Microsoft stock and see how it compares to Microsoft? And what we find here is 64.7% or 64.9%, depending on what you're looking at, although that is the gross profit margin, not the operating margin. Let's see if we can get a better number here for the operating margin. The current operating profit margin for them is 31.51%, a little bit more than Apple, but still, within 9 points there, that's within range. So, you'd have to make a decision there, and I would compare it to a couple of other technology companies too, to kind of get an average to see where Apple ranks in that. So that's how you would do a performance indicator. So let's look at now valuation parameters. And valuation ratios are related to the current market prices of shares, so they're quite volatile in general. And as someone rightly said, profits are made when you buy and not when you sell. So in that regard, valuations are key. However, prior to using valuation, stocks should pass the other 2 criteria of financial stability and performance, which we can kind of say Apple probably has. Maybe the performance valuation was a little bit off, but each of these valuation ratios should be used in comparison to the same ratios with other potential stocks within the same industry. Again, you're going to want to compare. And valuation parameters, there's 6 different kinds. I will say this. when you open the financial page of the paper and it gives you the list of the stocks, the valuation parameters will be the first things they'll tell you about that stock. And usually the first one they'll use is the price to earnings ratio, which they'll have listed as P/E, and then give those numbers. And all that is the current market price divided by the earnings per share. In other words, if there's 1 million shares and they made $1 million last year, then the earnings per share is $1. So that's what price to earnings ratio is. Price to book ratio is where the current market price is divided by the book value. The dividend yield is dividend per share divided by the current market price. Dividend payout ratio is the dividend per share divided by the earnings per share. And price to earnings to growth is the price to earnings divided by the earnings growth. And then finally, the price to earnings to sales growth is the price earnings divided by the sales growth. So like I said, the most common one you'll see is the PE ratio, the price to earnings ratio. And again, all that is the current market price of the stock, what is the current market price of Apple? Let's just erase all this and look at Apple stock. And Apple stock's currently $317.47. So the current market price, $317.47 divided by the earnings per share. So if we go Apple stock earnings per share. And in the second quarter of 2020, $2.55. So if we go back here, and I don't remember what that, it was 255, right? So divided by 2.55, whatever that current price was, I know it was 300 and something. 317.47. So if I get on my calculator here and I go 317.47 divided by 255, then the PE ratio is 124.50. And again, I did that on my calculator, but I could certainly just as easily go PE ratio and find that it's, well, in the end of March, it was 1275. Today, it's 2413. So I probably got some bad numbers there when I was doing that on my own. This is why it's more important to trust a professional and look it up. So we've got the price to earnings ratio there. And again, if we look at the price to earnings ratio of Microsoft, for example, let's see, what is theirs today? It's not telling me very easily. I'm not finding a site that would tell me that. Well, here's one. As of May 15th, 2020, they were looking at about 30.53. So I don't know. At this point, two of those indicators are showing me that Microsoft might be a better investment than Apple at this point. And so, you know, you'd probably have to do a little more research if you already own it to see, okay, is this something I should hold or should I sell it and get on board the Microsoft train at this point? And of course, I wouldn't base it on just comparing against Microsoft. I'd compare it against a few other companies in the industry to find an average. And there might be other things in here that show you, okay, well, Apple's lagging a little bit right now, but there's lots of room for growth to consider in there. So right now, my advice with Apple would be sell. Based on just the comparison with Microsoft. But again, that's an incomplete advice based on just very limited research. I would certainly want to do more research. So if we go back to the Microsoft Journal or the MarketWatch Journal number 4, and you'll notice that we did a financial stability indicator, we did a performance indicator, and we evaluated the stock on a valuation parameter. What does the future likely hold for our stock? For Apple, based on what we've seen that they're a little bit below the industry average. It could be because of the coronavirus. And so I would say if you own it now, and this is where we'll get down into number 5, what should you likely do with each of your stocks within the next year? I would recommend holding it if you already own it, or not buying it or selling it. So hold or sell would be my recommendation based on all of this. Now, the next question, what does the valuation of stocks allow for investors to do? Well, that's, a pretty easy question based on this. It allows us to actually take an educated guess based on quantitative evidence rather than just gambling and going, I think it might be this. It allows us to run some models, which if you follow the coronavirus stuff, everybody's, the models. Models are not science. It's a better educated guess, but it's not science. And so sometimes your modeling can be wrong. There's lots of factors. Who would have guessed about all this coronavirus stuff, for example? And so it allows investors, though, to take a better educated guess about the possibility of investing in something that will grow and give them a return on that investment. So that was Market Watch number 4. That's all there was to it. Do you have any questions? Okay. Well, then I'm going to end the meeting for today, and hopefully we'll see you tomorrow, or actually this afternoon, and we'll go over Market Watch number 5 and what I hoped you would get from there. So hopefully I'll see you then.